In business today, three things to know. First, the U.S. economy comes to a screeching halt. What's behind the glacial pace of the first quarter domestic product coming up? Then, Fannie and Freddie are back on shaky ground. A new report says the nation's largest mortgage backers could collapse if the economy turns south and might need another multi-billion-dollar bailout. And the big pharma cocktail. Why are so many merging and what it means for the healthcare industry? Arise Exchange starts now. I'm Andrew Schmertz. The U.S. Federal Reserve did what was expected Wednesday and cut another $10 billion from its stimulus program. The bond buying program now stands at $45 billion a month. That decision came at the conclusion of the Fed's monthly two-day meeting. The central bank says the economy continues to gain traction, but maybe not as much traction as thought. Earlier in the day, the government came out with its estimate of the first quarter gross domestic product, and that was a bit of a shocker. Here are the numbers. The GDP barely grew, up just 0.1% compared to the 1.2% expected. That is the worst performance in 3 years. On all the news, the markets did finish up. Here are the final numbers. The Dow Jones Industrial Average, that's a record high, 16,580, up 45.5 points. The S&P 500 closing at 1883, and the NASDAQ up a little bit better than 11 to 4114. And looking at stocks we're watching today, Facebook unveiled its anonymous login feature that allows users to sign into apps without sharing their identities. The apps will be forbidden from collecting personal data from people who use the feature. Facebook closing at $59.78, and that was up. E-commerce company eBay is repatriating billions of dollars in cash it's been holding offshore, choosing to pay a hefty tax bill in the U.S. in order to access funds it says it might need for future deals. The company says it will take a $3 billion non-cash tax charge in the first quarter to facilitate the repatriation of the offshore profits, eBay closing down to 71 to 51.83. And shares of Twitter falling more than 10% in early trading, an all-time low as investors voice concerns over the company's failure to meet growth expectations. Twitter down nearly 4 to 38.71. Commodities, gold closing down, and oil pulling back below $100 a barrel. Other U.S. data out today. Payroll processor ADP reporting private employers hired 220,000 more workers in April. That's the highest monthly total this year. And applications for U.S. home mortgages fell 5.9% last week to their lowest level since December 2000, as both refinancing and purchase applications declined. Our frequent guest, Peter Schiff, thinks the Fed is fooling itself about the economy. Schiff says we are already in a recession. The CEO of Euro Pacific Capital joins us now from Connecticut. Peter, welcome back to Arise Exchange.
Thanks for having me back on.
So if you speak to a bunch of economists that we've been hearing, they will say that growth is still going to be about 2.5%, 3% this year, that this is a bump in the road, that there was a lot of variables like the weather in the first quarter. You disagree with all of that?
Well, I think that's wishful thinking to blame the fact that first quarter GDP was essentially zero. And I think there's a better than 50% chance that when they make the revisions to the original estimate, that it's going to be a negative quarter. And again, all of this is based on the government's contention that inflation is averaging 1.3% annually. If inflation is higher than that, and I believe it is, then in fact the economy is already contracting and has been actually contracting for years. We're deluding ourselves by pretending that the economy is growing.
And so is the Fed delusional, or does the Fed know better and they're just going with this veneer of things are getting better, and if they say it enough times, maybe it will be true?
Well, I think the Fed believes that its job is to cheerlead for the economy. No matter how bad it looks, to pretend things are better than they are, because I think the Fed is hoping that by talking the economy up, that maybe it will be a self-fulfilling prophecy. But the Fed is always wrong about the economy. They always overestimate the economic performance. That can't be an accident. This is by design. And I think, once again, the Fed is too optimistic. And I think, unfortunately, they are going to abort the taper. They're going to come back with even more QE. But the reason that we don't have a real recovery is because of the Fed. QE is the problem. Interest rates have been too low for too long. They have to be allowed to rise. Asset prices are too high. The Fed can't keep propping them up. They have to let prices go down so that we can have a real economic recovery that actually improves the living standards of the vast majority of Americans, not simply making a very few people rich at the expense of the much broader population.
Yeah, we'll talk about that in a moment, but I'll ask you about the $10 billion that they tapered today. You had said previously that about the $40 billion level was about as far as they can go. You're holding to that?
Well, I don't know how many more, $10 billion tapers they're going to do. Will they get down to $35 billion or $25 billion? I think they are going to stop it before it gets to zero. If they don't, then we'll be in a recession. The stock market will be lower. Real estate prices will be lower. The wealth effect will be working in reverse. And so the longer the Fed waits to slow it down, I think the more stimulus they're going to be coming back with to try to rev it back up again.
So do you think right now, if things stay on track, the second quarter GDP will actually turn us into a recession? Are you thinking we're that close to it? The numbers, at least, that the government puts out. I know you say the numbers aren't accurate.
Yeah, but I think it's very close, even by the government's own estimate, because everybody is attributing the sharp decline in GDP in the first quarter to the weather. And I don't think the weather had anything to do with it, or very little to do with it. If you look at all of 2013, GDP was up 1.9%. That marked a decline from the previous year, where I think 2012 was, 2.6%. So the economy was already decelerating. And if that was happening while the Fed was stimulating, there's no way that 2014 is going to have a higher GDP number than 2013 when the Fed is removing all the stimulus that propped up the economy in the first place.
So what about the labor market, though? Because we're getting a report today, the private sector jobs are growing. Are these quality jobs? Are these the job growths that the Fed and everyone else wants to see?
Well, they're not quality, and I think the guesstimate that we got today from ADP is probably too optimistic, and they'll probably end up revising it down. My guess is that the official numbers that we get on Friday will not be as robust as what ADP guessed this morning. But even if you look at their numbers, the ADP numbers only have 1,000 jobs in manufacturing. Those are the kind of jobs we need. The jobs that we're getting are temporary, part-time, service sector jobs, low-paying jobs, jobs without benefits, jobs that you really can't live on. These are just, stopgap type jobs that people really can't survive on the kind of jobs that we're creating unless they substantially reduce their standard of living. And that's really what we're experiencing in the U.S. labor market.
So what do you tell clients right now? What are you betting on, basically? That the Fed is going to come back and pump a lot of money into the economy, or that the Fed is going to start taking your view and go a different direction? Because that's really where you should be allocating your investment dollars. Which one do you think is going to happen?
Yeah, well, the Fed is not going to take my view. The Fed is not going to learn from its mistakes. To believe that they're going to do that doesn't really have any historical precedence. I think Janet Yellen is going to repeat the mistakes of Ben Bernanke. She's going to repeat the mistakes of Alan Greenspan. She is going to do even more stimulus. We're going to have more reckless money printing. And it's not going to work in the sense that it's not going to create legitimate economic growth. It's just more inflation, a weaker dollar, higher consumer prices, a lower standard of living for the vast majority of Americans. But for my clients, for investors, they need to understand what this means for the markets. It means a much lower dollar. It means higher commodity prices. It means a big run up in the price of gold. And people need to be invested accordingly to protect themselves from the inflation that the Federal Reserve is going to unleash to try to artificially stimulate this economy.
Peter Schiff, thank you so much. Republicans in the Senate filibustered a bill to raise the federal minimum wage. The bill would raise the minimum wage from $7.25 to $10.10 over the next 3 years. President Obama held a mid-afternoon news conference to criticize Republicans for standing in the way. Our Washington bureau chief, James Blue, was at the White House. And James, I want to just start by a little surprise for you here. You got to ask the first question today, and we have a photograph of it. We can put that up. I'm told we have it. There you are. James, raising your hand from the back seat. What was that like? It's a big news day for here at Arise News. What did the president have to say?
Well, unfortunately, the president was not in the slot today. It was his spokesman, Jay Carney. And I asked about the young girls who have been held hostage in Nigeria, and he referred me to the State Department. But, I did ask a question.
All right, excellent. All right, so what did the president have to say about unemployment? Not unemployment, minimum wage.
Basically, the president suffered a political defeat today, and it was a rally. He didn't take questions, but he was really trying to get people pumped up about the minimum wage, and this is what he had to say.
The workers who benefit from a minimum wage increase often work full-time, often in physically demanding jobs. They average 35 years of age. Most low-paying jobs are held by women. But because Republicans in Congress said no to even allowing a vote on the floor of the Senate, these folks are going to have to wait for the raise they deserve.
James, why put this in front of the Senate? The Senate knew this was going to fail. They know it's going to fail in the House. This is political?
It's all political. And, he mentioned that most people on the minimum wage are women. And what the Democrats and what the president are really trying to do is mobilize a group who don't have a good history of turning out during midterm elections. These elections in November are crucial for the Obama agenda, and they are doing everything they can to get women, minorities, and their voters to the polls.
And where does the president think that the country is right now on the minimum wage? Is he betting that this is where the country is heading, or at least this constituency?
I think he recognizes this is a good issue for his constituents. You have minorities, people of color, young people, women, that sort of Obama coalition that elected him president 2 times. Those are the people who don't show up at midterm elections. And so what the White House is doing, recognizing that it has no chance up on Capitol Hill, they are trying to push their agenda through these rallies at the White House, and just sort of by saying to people, if you don't get out and vote, you can't get the things that we think you need.
So pretty sure this news conference was probably scheduled long before the vote even happened. James Blue in Washington, thank you.
Bye.
Coming up, Fannie and Freddie may be heading for another fall, and you could pick up the tab. Arise Exchange is coming right back.
I think news does make people put things in black and white terms, just so that they have a dividing line between what their viewers like and dislike.
When they see a person of color, they either think that they're not going to do anything, they're either on drugs, or they got pregnant at an early age. And I just want to say that that's not true.
It tends to reflect more the interests of the upper income people and the upper income interests.
Arise News, every culture, every angle.
As you know, financial institutions have been undergoing federally mandated stress tests to determine if they have enough cash to survive another downturn. 2 of those are Freddie Mac and Fannie Mae, 2 firms that buy mortgages from banks in order to provide liquidity to the market. Well, both have failed those stress tests big time. According to the Federal Housing Finance Agency, a government regulator, Fannie and Freddie might need another $190 billion in government aid if home prices collapse like they did in 2008. TV analyst, Market Watch contributor, and TradingWithCody.com publisher Cody Willard joins us from New Mexico to try to walk us through what this means. Cody, welcome back to Arise Exchange. This isn't such a surprise. I mean, neither of these companies have any cash in the bank, right?
No, but let's just set the record straight. These stocks are still sort of publicly traded. The government and Treasury Department bought most of them. Every dollar that they every part of the equity they possibly could, and left about 20% of it public, because that is what they would have. If they bought any more than that, it would then go on the United States government's balance sheet. This is an off-balance sheet scam that is the entire
Sounds a little
Fannie
Enron-like.
and Freddie Mac are penny stocks, and they have so much debt, so much crappy goodwill, and so many crappy assets on their books still that they are and always will be totally and irretrievably bankrupt.
So why do they
to bail them out?
Why do they still exist then?
Again, let's put it blunt here. Every dollar that goes into Fannie and Freddie ends up either in a slush fund for the Republican-Democrat regime or directly, especially at this point, into a too-big-to-fail bank, which, how do you differentiate the regime from the too-big-to-fail banks at this point? Because these guys are still wheeling and dealing every day these crappy mortgage-backed securities to these Fannie Mae's and Freddie Macs. That's why they are $170 billion in the hole if there's a downturn. Let's be realistic. Every day, taxpayer support is funneled into these guys, and it ends up either in a slush fund or in the too-big-to-fail banks.
Okay, well, we know from an adjective standpoint what you feel about both of these entities, but they both serve, some would argue, a very important purpose here, which is to basically backstop mortgages, which helped increase the amount of people who are able to buy homes. Because what we've heard is if they didn't exist, banks would not lend and would not create 30-year mortgages. Is there any truth to that?
No, there's absolutely no truth to that whatsoever. We are sitting here in a 0% environment forced upon us by the same Federal Reserve that is enabling these Fannie and Freddies and too-big-to-fail banks. And there are desperate people out there wanting to lend money through a banking system that would actually end up giving mortgages to people who would pay 6, 7, 8%, and some of that money would end up actually back in those depositors' pockets. This is a scam. It has been from day one. There was home ownership in America before Fannie Mae and Freddie Mac, and there will be after.
There were 30-year mortgages, though, to the extent that they are today?
Maybe or maybe not. Who cares? I don't care about 30-year mortgages anyway. If someone is a reasonable saver and has a big chunk of money, a decent amount of money to put down on an actual asset of a home that they want to live in, there are lenders, there are people who have saved money who would want to lend to that person.
So,
a banking system, not Fannie Mae or Freddie Mac, and a scam system is needed in place.
And there is some movement in Congress among some to actually extinguish these two organizations. What would that look like if they went away? What, if anything, should replace them, and what is the mechanism for the government to basically end both of them? Because there has been some talk to doing that.
There is no end in sight with the Republican-Democrat regime in place as it is. These guys are completely owned by the banking system that needs Fannie Mae and Freddie Mac's hundreds of billions of dollars of welfare support, stealth bailouts every day, every year goes into those bankers' pockets, and that will never change. There's no mechanism that's going to end Fannie Mae or Freddie Mac anytime on the horizon. This would be a great first step if you could end them, but I don't see it happening. It's still just going to be a Ponzi scheme until at some point it collapses on those guys.
Okay, Cody Willard from tradingwithcody.com and Market Watch contributor. Thank you for your input today.
Hey, thanks so much.
Time now for our business ticker stories making news around the world. It looks like Russian President Vladimir Putin has problems within his own borders now. The International Monetary Fund says the Russian economy is in a recession, made worse by Russia's military adventure in Crimea. This is hardly news to U.S. companies such as McDonald's and Ford that operate in Russia, many of which say sanctions and the weak currency have made business there very difficult. And ratings agencies, as you know, recently downgraded Russia's debt. Too big to fail may not be too big to jail. U.S. prosecutors are weighing criminal charges against European banks Credit Suisse and BNP Paribas. Credit Suisse is facing a criminal probe into whether or not it helped Americans evade taxes, and BNP is being investigated for doing business with countries in violation of U.S. sanctions. The charges would be a break from the precedent of brokering settlements for banks considered integral to the financial system. The world's largest retailer now going to offer auto insurance to its customers. Walmart has teamed up with autoinsurance.com and launched a new platform that offers insurance policies and compares rates across different providers. The program is already available in 8 states and will become nationwide in just a few months. 2 Italian fashion icons are trading in their fancy clothes for prison jumpsuits. Domenico Dolce and Stefano Gabbana have been sentenced to 20 months in prison for tax evasion in Italy. They will also pay more than $471 million in penalties. And the need for speed is going green. British engineers at Trident have announced a new car that reportedly tops 200 miles per hour and can travel 2,000 miles on just one tank of, get this, vegetable oil. Trident says their Iceni Megane supercar is the most fuel-efficient sports car on the planet as it runs on potentially homegrown biodiesels such as soybean or linseed oil. They've released 3 different models, including a convertible with prices starting at $161,000. A lot of green for green. The savings start, they say, when you don't have to pay for gasoline. You will have to buy a bunch of vegetable oil. Ahead, if you want to attract Barbie, you gotta look like Ken. So thinks our favorite person of the day, who spent 6 figures on plastic surgery. Next on the Rise Exchange.
Mainstream news has covered all of the issues of the world, which are like this, through a very narrow lens. And at Arise News, we do things different. We cover every culture, every angle. Our mission is to go to these places, to these communities, whether they're in Africa, whether they're in Europe, Asia, the United States, the Caribbean. And we're going to find these stories, and we're going to tell them to our audience. Stories that they probably never heard of before, and stories that they'll find interesting and engaging.
Time now for our favorite person of the day, when we pick one person who grabbed our attention and not for the right reasons. Today, it is a flight attendant who spent close to $180,000 on plastic surgery to look like a Ken doll, Barbie's fake doll boyfriend. You can decide if it worked. Here are the before and after photos of 30-year-old Rodrigo Alves. On the left is Alves before he tried to turn himself into a plastic doll. On the right, the results. Alves had 12 major operations and 8 smaller procedures over the past 10 years. He had 3 nose jobs, pec implants, liposuction. He had surgery to create a fake six-pack, clearly going to the gym was too much of a hassle. Fillers were added into his arms, and he had a procedure done known as calf shaping. Unfortunately, things went south in January when his arm got infected from an injection of gel used to make him look more muscular. That infection left him temporarily paralyzed, and he nearly died. So shaken by the ordeal, he decided to finally see a doctor who could really help, a psychiatrist. Alves was diagnosed with body dysmorphia, an unhealthy obsession with one's appearance. Now he acknowledges he has a problem, but also says he wants to get another nose job, all in an effort to one day be as perfect as this, a real Ken doll. And that's why Rodrigo Alves is our favorite person of the day. Coming up, what's behind the merger frenzy of drug companies? You're watching a Rise Exchange.
If I was building my own news network, first thing I think I'd want high-quality reporters, very educated, intelligent people.
Hello, I'm Francesca Maxime.
I'm Julian Phillips.
I'm Wendy Gillette.
I'm Sophia Songhai.
I'm Gary Anthony Ramsey. Thank you for joining us here in New York City.
I would like to see more people of color represented in high positions in media.
We've got world-class journalists, veteran journalists who have been in this industry for decades, not just in front of the camera, but behind the scenes as well.
People need to understand the problems that are going on in the community are much closer than we actually think they are.
Kayla Phillips is one of the shoppers who is suing Barney's, and she is here with her attorney. What is it that you want from them?
Not to judge every African-American person that comes in your store.
There's been a massive overhaul of the pharmaceutical industry nationwide. This year alone, there have been more than a dozen major mergers of companies worldwide, including Pfizer's proposed $100 billion buyout of AstraZeneca, Valiant's bid for Allergen, and last week's 3-part deal between Novartis, GlaxoSmithKline, and Eli Lilly. So what does it mean for the industry, and will customers end up footing the bill? For that and more, we turn to Jeff Kraws, Senior Pharmaceutical Analyst with Crystal Research Associates. Jeff, welcome to a Rise Exchange. Thank you so much. So what is driving all of this merger activity? We have seen a rise in M&As generally throughout all industries, but there seems at least a perception that the pharmaceutical industry is just interested in tying up.
It's faster for them to buy the revenues than to invest long term. They're also strategically trying to pair themselves up so they're not the last one without a seat. What they're basically doing is strategically looking at their options to figure out where they don't have the strength, trying to buy those assets if they can, and sustaining their earnings while they're doing it is the key trick.
And is part of what's going on that many of these companies don't have a lot in the pipeline, in the R&D pipeline, and they want to buy basically somebody else's pipeline?
Well, they've been spending, part of that is true. They've been spending a lot of money, but what they've been trying to do is buy differentiated technologies. Because right now in the healthcare arena, if you don't have a differentiated technology, you're not going to be able to charge premium pricing.
What do you mean by differentiating technology?
You have to have something that is new and improved, really new and improved. It has to help people survive longer, it has to work better, it has to have fewer side effects, then you can charge a premium. Otherwise, the pharma companies who have been losing a large portion of their portfolio to generics then don't get their premium pricing. So they are right now trying to do two things: sustain their earnings by buying companies and try and acquire their pipelines so that they can bolster what they have going forward. Keep in mind, areas like oncology with this aging population, there are cardiovascular, there's oncology, there are areas that are going gangbusters.
When you look at these tie-ups, the names we mentioned are some of the big names merging with other big names. But what about some of the smaller deals? Are big companies buying smaller biotech firms? Are they looking for much smaller deals out there?
They are. You're seeing a lot of the smaller biotechs merge with the medium biotechs. You're seeing some of the bigger biotechs buy some of the medium and smaller biotechs. Pharma's always had a track record. I was the head of competitive analysis at Bristol Myers Squibb for a number of years. So back in those days, you didn't want to acquire something that they had a product on the market. Nowadays, they really want the product to be out there and proven. If it's not, they have to identify it as having an extremely disruptive technology, either to their revenue stream or to someone else's, and then they'll go after it. Otherwise, they tend to wait.
And what kind of patent risk is there then when they're buying up these entities? Because the patent is still a very short cycle for many of these drugs.
17 years is what they get on the patent from the first day they're filing it. Some of the drugs have very short patent life left, but some of these companies have drug delivery technology that they can apply to those drugs to get an extended patent life.
So from an investor standpoint, historically, how have these mergers worked out? Because usually when you have companies in industries merging together, there are a lot of problems, cultural problems, operational problems. Historically, how have these worked?
Case by case, some of them have worked out really well, some of them have been disasters. But it really depends on the individual company. We always say management. That's really a very key element to making a merger work. And I think with the pharma industry, we will continue to see consolidation in the industry. But I do believe with the aging population and the increased utilization of drugs, the prescriptions represent the right prescription for financial health.
And do you expect significant layoffs from all of these mergers?
I do. They will create synergies, but they'll create synergies largely by downsizing and getting rid of duplicative functions.
And who's therefore protected the most inside of these companies, do you think? The scientists? The
acquirer.
The acquirer is the company that's acquiring it. If you work for the acquirer, you're in far better shape.
You're in far better shape.
So what's the regulatory environment then? Because we haven't heard a lot of pushback just yet on some of these mergers, but do you expect that to happen?
Probably not, because a lot of them have, the companies are getting so large that where there's going to need to be divestiture, it's taking place ahead of time. You're seeing that with the GlaxoSmithKline and the Novartis, where one company really wants to gain the vaccine expertise, particularly in meningitis. And, on the consumer front, you're seeing an Excedrin and a Theraflu merging up with a Sensodyne and an Aquafresh. And
so there's sort of two different products.
Two different products.
And does that therefore, should consumers not worry too much about pricing power of these deals? Are you seeing pricing going up because of mergers?
I don't think you're going to see pricing go up too much, because right now with the new Affordable Health Care Act as well as the competitive arena, healthcare is still early as far as, in the merger game. Even though you're seeing tons of mergers, it still is very early, because this is not an industry where you're down to, 1, 2, or 3, for instance, mobile phone carriers in the United States. The human body functions very differently, and your primary function here is you have to have a superior product. If you have a product that functions better in the human body than someone else's product, you'll be able to charge a premium. If you don't, you won't.
We're starting to see a big explosion in healthcare costs over the last 30 years compared
to
the last 30 years. Is this related to the Affordable Care Act, do you think?
I think it's not related to the Affordable Health Care Act yet. The first quarter saw the largest healthcare spending with that 9.9% of GDP. There really aren't that many people signed up for it yet. Even with the 8 million newest numbers, if they're accurate, that sort of came towards the end of the first quarter. But you can expect healthcare expenditures to increase significantly with that program.
Okay, Jeff, thank you so much for your analysis
Pleasure.
today. Friday on Arise Exchange, we're going to take a look at the impact of the U.S. shale oil production on Nigerian oil exports and how this affects your wallet. Time for another look at the markets today. Dow Jones Industrial Average closing at a record high at 16,580. The S&P 500 up 5.5 to 1883, and the NASDAQ up about 11 points to 4114. I'm Andrew Schmertz. Thanks for watching Arise Exchange. We will see you again here on Thursday. Have a good evening, everybody.